Someone was trying to give a little bit of applause. I think it's a good idea to do that. The panelists will, I'm certain, share many insights which are very important in the time of change that we are living through. The change is incredible. We feel it in media very strongly. On one hand, the entry barriers are changing. On the other hand, way people consume information. That changes the speed of business. That changes the style of life. And that changes division of economies and the capital flows that follow, I believe. So we're to discuss Poland, Europe, and the new division of global economies. And let me start with quite general question. I understand those macroeconomic trends which has been discussed for a number of years already. The shift of economic power toward East is still happening. And I guess if not for central banks of developed world, there might have been a situation that the shift might have been already over. It might have been already done for. How have central banks changed the course of history? Michaela.
Well, I think if we look around the world today, it's clear that the unorthodox monetary policies that followed in the wake of the crisis were very, very significant in ensuring funding for the financial system and preventing a collapse of the global financial system, which would, of course, had very extreme negative ramifications around the world. But I think where these policies are becoming increasingly interesting today is that we also see in the linkages between the emerging and the advanced economies that if we go back 20, 30 years, it was a one-way street. The linkage was really from the advanced economies to the emerging economies. But what we've seen with the crisis is we've seen it's become more of a two-way street. And also what we've seen is we've seen the importance that financial flows have taken upon in this situation. And I think as we look ahead and we start contemplating the exit of QE policy by the Federal Reserve, we have an interesting paradox, which is the tug of war between liquidity and fundamentals. And our view is that as liquidity pulls back, this will have global ramifications because what we'll really be left with are the questions of just how strong the fundamentals behind them are.
And are they strong?
Well, I think they are varying strength around the world. And I do think that if we look at the emerging markets, I'm always reluctant with these sort of brushstrokes emerging economies because, of course, they're very, very different stories we're talking about. In the case of China, we think that the economy is seeing a structural slowdown. In fact, when we get to 2020, we expect that Chinese growth is going to be somewhere around 4 to 5%. It's a real major structural shift that's going on there. If we look at emerging Europe, we still have fairly good expectations for growth, but of course the growth rates there are nowhere near the type of growth rates that we've been seeing in China. If we look over to the commodity producers, I do think that in terms of a commodity boom, the big driver of the cycle is now over. We will see some further improvement in commodities, but the big cycle there is over, and it'll be a real challenge for economies like Russia and Brazil to find other growth drivers for the economies moving forward. So a very mixed picture.
On the exit from those non-standard measures that were taken by central banks, and for ECB, for example, there is a broad range of loans being used as a backup for financing from commercial banks to central bank. You think we'll be able to escape the inflation trap because the liquidity is huge, and if the multiplier will really kick off, will they be able to take off the liquidity fast enough?
Well, that's an excellent question. And I think what we have to recognize is that the reason that the exceptional monetary policies have not been inflationary to date is essentially because the credit channels have been broken. So it's really, it's like driving a car. You want to find the right gear for the speed of your engine. And I would say that as we move forward, it would be extremely dangerous if the Fed didn't pull back QE in time, But at the same time, you can see that's why the markets are uncomfortable. So our view is we're actually entering a long period of normalization of interest rates. And come 2017, I expect the 10-year bond yield in the US to be back at 5%. So if we look at the situation, we do believe that you can avoid inflation, but it's very much dependent on reining in that excess liquidity. And I think in terms of the markets, we're in for a bit of a choppy ride when that starts to happen.
Thank you so much. Mr. Rahbari, are we still going to see this shift? How is the developed West going to look like in terms of its attractiveness for investors, but also way of life? Is the situation really changing?
Well,
Still?
it's a great pleasure to be back here at the IPO forum. I was very interested to listen to these remarks. When you look at Western Europe, I guess the picture isn't quite as positive or quite as encouraging. When you look at Poland's neighbors to the west, and that's not just the euro area neighbors, but also the EU, I guess broadly four things apply. And the first is that it's really still, it's a continent that is fragmented. So you essentially have three blocks, a part that's seen as a safe haven, another part that is essentially at best a speculative, of speculative interest, and then you have the center or the east of Europe that is offering a different balance of risks and opportunities. Now, the central bank action that has happened in Europe, and the ECB has clearly been fundamental in preventing an even more difficult period, has had some benefits in the sense that Europe is changing, it is reforming and adjusting, but this adjustment and reform is happening slowly. The positive spin on this story is that there are clearly competitiveness benefits that are happening in Europe, somewhere between 10 to 40%, according to some measures, of gains, competitiveness gains have been reaped in the weak southern economies. But at the same time, when you look at these countries, there's still really such a large amount of ground to be made up, and then there are a few others, like France, that are really just embarking on a route towards reform. So the room that's maybe been created by policy action, by ECB action, hasn't quite been used as effectively as it could have been. And that brings me to my third point, which is that if we look at Europe, we probably still look at an extended period of weakness. My neighbor to the right said that we're looking maybe at 2017, even in the US's case, for a period of long period of normalization to come to an end. And I think that very much applies, or is probably maybe even a tad optimistic in the case of Europe. We're looking at a long period of economic weakness, a long period where interest rates will remain low, partly because inflation is continuing to be weak, but very much both interest rates and inflation will react to economic weakness. But let me end these brief remarks with a somewhat more optimistic spin, which is that this is a period of adjustment and bringing Europe to a more stable fundament. It will mean for both the euro area and for the EU, even though there are actually additional question marks about the EU as well, that it will end up in a setup that just makes a lot more sense. It didn't make sense when the euro was created and the EU had some open question marks as well. But when we look ahead, and it will take a number of years, I think the investment environment ultimately will benefit, and it will be a place that will be worth being in and worth joining. So for Poland, I guess what is of interest is that it is of interest to remain orientated towards the West as well as to the East, to keep its place in Europe to some extent.
Thank you. Let me jump to Mr. Chwiejczak, who's, by the way, our frequent guest at TVN, CNBC, and thanks for that again. Do you think the relative underperformance of Central and Eastern Europe, of which we've heard in the presentation earlier during this meeting today, you think it will help keep the West rich and sort of slow this shift of economic power?
Well, I'm for solidarity, and I think that the fundamental question and the fundamental problem which we still have in Europe is that still we are deep in a crisis. It's a very complex crisis because it's a combination of three crises. It's a sovereign debt crisis, it's a banking crisis, and in some cases it is also a competitiveness crisis. And the question is whether we have done enough in the core of Europe, ECB has done enough to support reforms. Well, on sovereign level, possibly yes, because basically spreads has tightened a lot. But the problem is with the private credit, and private credit is not flowing into the economy. And that is creating a significant problem. Europe is not growing. And without additional actions, I don't think that Europe will start to grow very soon. So additional actions are needed. And then the question is about Eastern Europe and its tightness to Western part of the world. Can Eastern Europe grow without Western part recovering? I doubt. Poland is quite unique because Poland was was in avant-garde of a crisis. Sort of a approach was completely different. Instead of austerity, Poland pursued a fiscal stimulus, and it worked. It worked perfectly. Polish GDP between 2009, 2011, 15% in total up. You cannot find other country in Europe, except Turkey, which can show you such a growth. The question is whether it can be sustained without a reform. Poland is in great shape because overall debt to GDP is very low. And if you think about net debt to GDP, it's very, very low, it's 30%. Polish model growth is very simple. Tap EU money, leverage, and grow. And I think even with very weak Europe, Poland can keep outperforming.
Can Poland grow without the West? Piotr Bielski.
To a large extent, I agree with Piotr, but at the same time, I would also like to emphasize because I agree that Poland has many strengths and has potential to grow faster than other countries. But at the same time, we also have to learn from examples of Southern European countries and make some parallels and look, for example, at external imbalance, which was one of the drivers of crisis in Southern Europe. And if we look at experience of Polish economy, of course we are still far from the position of Greece or Portugal or Spain. But if you look at experience of past several years, especially prior to the Eurozone crisis, we did manage to accumulate quite substantial external imbalances in Poland. And if not the crisis, we would accumulate quite large external imbalances that could, in fact, undermine substantially our growth potential in future. In fact, already now, Polish international external position is quite significantly negative, which means, and Poland still is a country with shortage of savings. We not only have a rather low investment rate in Poland, which is not very good, but we also have shortage of savings. So in order to boost our investment rate in Poland, the only thing we can do is to borrow even more from abroad. And this is a kind of a threat for long-term growth potential, because if we borrow more from abroad, we would accumulate external imbalance even more. That, if sustained in time, that could endanger our long-term growth potential. And that's why we need to reform the economy. And in my opinion, the main direction of this reform would be to stimulate private savings in Poland. Because without those private savings in Poland, long-term growth potential would be reduced.
When you're saying about the private savings, the thing that comes to my mind is a great discussion that we have in Poland about pension system, which is disputably private and disputably public, just as it was as it happened, well, maybe I should say that Hungary is an example of what might happen, although it's probably that it's unlikely. If there would be, if the state was forced to tap into that cash, how that would change the situation in Poland?
Yeah, just like to say a few general remarks, first of all, on emerging markets. Just cast your mind back about 5 years ago to what the situation was after the acute phase of the financial crisis ended, when the so-called Anglo-Saxon model of economic and corporate governance was widely perceived as being utterly discredited. Over the last 2.5 years, since we initiated coverage on emerging markets at Deutsche with a very negative recommendation, in other words, underweight emerging markets, the US has actually outperformed global emerging markets by almost 50%. Now, normally the markets are telling you something about what's actually happening in the underlying economy. And I think what they're actually telling you in the case of emerging markets, particularly in the case of the BRICS, is that, as Mark intimated in his speech, there's a very serious governance problem in some of them. Now, I'll just refer to a comment made by my colleague from Soc Gen about the potential for China to dip to a 4 to 5% growth rate by 2020. This is a very, very negative projection, and it actually has profound implications for what happens to the emerging market asset class, because that growth premium, which they previously enjoyed, will come under pressure. Now, I happen to share that pessimism on China. It's certainly not the Deutsche House view. As a house, we tend to have more optimistic projections. But I think what we're seeing in China, as well as what we've seen in Brazil and Russia, is actually something approaching a crisis of governance at the corporate level. And that relates to the point you're making about Hungary, namely the involvement of the state in the economy, the increasingly interventionist tone which has taken place. And just by a sort of recommendation, the last thing you want to happen in Poland is for Poland somehow to be put into a similar category as Hungary or Russia, because frankly that would be quite unjust in terms of the fundamentals and in terms of the massive achievement that this country has made in terms of governance over the past 20 years or so. Now, just again to remind you that about 85% of the MSCI Poland by market capitalization is actually comprised of state-controlled companies. Because governance of these companies is much better than it is in Brazil or Russia as a generality, and I would argue, unlike Mark, in China itself, where I think there are serious issues of corporate governance which will impact the broader economy, that hasn't really been too much of an issue so far. And by the way, as you know, in Poland, even there have been some issues with specific companies, particularly in terms of the influence of government on policy with regard to capex and acquisitions. So I think we need to be very, very careful indeed, because what we're likely to face over the next few years is actually a shortage of money coming into emerging markets. And actually what we're likely to see now is a reorientation of money away from the emerging world towards the developed world. At least that's our view. And I know that's kind of quite counter-consensus, but in a sense it's what the market developments over the past couple of years are already starting to tell you will take place.
All right, and the same question to David.
There are about a dozen questions embedded in this discussion. Let me just give you, I think, what's important to the audience, which is what's going to happen to the Polish stock market, what's going on with pension reform, where do we see it developing. I think on the pension reform, what we will end up seeing is an extension of the changes over the last couple of years, which is the government trying to take cash from the pension fund balance sheet that's in government bonds and moving it onto the public sector balance sheet. That will reduce the reported public sector debt. And I think everything that I've heard from both the government and the financial sector here is the government really, really wants to have an active pension fund community investing in the stock market. The doom and gloom I heard in Warsaw when I was here a couple of months ago, to me is overdone. And so what we're going to end up with is a smaller AUM in the pension fund sector with a greater percentage in equities. The other issue, I think, for shareholders, both domestic and foreign, is to look at that balance sheet imbalance between the government and the government-owned companies. The government needs the money. A lot of the government-owned companies have the money. How will the government access that cash? Dividends. And that is, I think, the primary attraction of the Polish stock market, both to domestic investors and especially to foreign investors, that prospect for dividends. So if we can see rational capex programs from a lot of the government companies, utilities, mining, et cetera, we're going to end up with big dividends, which will end up in a much higher stock market by the end of the year. When you look at our CEMIA strategy top 10 list, the two stocks we have in Poland are KGH and PGE. Why are we there? We're there for the dividend.
Haven't heard the last word, sorry. Why are they here?
Why are we there? We're there because of the dividends. We think we're going to get big old dividends out of KGH and hopefully out of PGE. We are, I think, still quite hopeful that they don't go overboard on new capex, either nuclear or hard coal, and the government decides that they'd rather take the cash out in the form of dividends.
Well, somehow we started with a very general subject and end up discussing a very particular case of Polish stock market and two Polish companies. I'd like to come back to the generalities. Poland seems to be a very good example, but the environment around Poland in Central and Eastern Europe is not that optimistic. Or at least the picture is pretty mixed. What is your view on a change, let's say, in next 2 to 5 years? I don't know, who of you would like to pick up the subject?
I think the
Please.
change will be positive. I think that change will happen this year. I think that the political agenda in Europe in general is in favor of that change. We have an election in Germany, and I think until the elections, nothing significant will happen, but after elections, Europe will have to answer the question whether it's a time for further unification and basically going forward, dealing with the problem of the past, which means adapt, and then basically think about more better way to finance the outstanding debt, to cheapen the funding of the outstanding debt, and basically to save for investment and for current demand. So I think that's sort of external situation. Then the second thing, which particularly Eastern Europe has to do, is to tap European money, cohesion funds, and that's a particular case of Poland. Next year, Polish investment program is starting, and it will have quite significant impact on GDP. I don't know what's the final number, but let's say it's 10 billion of zloty. So that will increase GDP by 0.6% of GDP. That's quite significant. If we are thinking about dividends in general, they are coming from GDP. We have a tremendous nominal growth in Turkey. That's why Turkish companies are rising tremendously, because you have nominal GDP growing by 10%. You lever up 4%, you have return 40%. That's why the price of those companies are going up. In Poland, you had a combination of very tight fiscal policy, very tight monetary policy, very tight regulatory policy, zero demand, and nominal GDP this year maybe will be 2%. It is not sustainable at all. So basically, the next stage is to answer the question, who will start to invest? And in current environment, which you have very little visibility in terms of what will happen next, I think it's state which should take the leading role, and then private sector.
All right, but from what you're saying, you believe in positive change, but
Yes,
from
I
what
do.
you said in the last part of your remarks, the picture is quite gloomy, and I don't see too much hope there.
Well, it is a hope. The whole situation is that when you are moving away from the normal situation, far away from the normal situation, then it's possible to make impossible things possible, to find a common understanding between debtors and those who lend, so lenders. And I think in the current environment, when the debt is the major problem of Europe, it's very important. It's how to share the burdens of outstanding debt. And I think that because the situation is getting so gloomy, it's actually positive. When you own to the bank 1 zloty, that's your problem. But when you own to the bank 1 million, it's a bank problem. That's sort of a situation.
Yeah, I always wished I was indebted in millions. That would be much less of my problem than, yeah. Michaela, I think you wanted to...
So, no, basically I wanted to pick up on this topic of Europe and convergence and these issues. I completely agree with the idea that when we look forward, Europe needs a new institutional framework. We're right now discussing about banking union, fiscal union, and these are very significant changes. And what it means is that for Europe, it's really a very strong integration process that's about to happen. And I do think that in this context, after the German election, that process will happen. But remember, in Europe, treaty changes are not things that happen from one day to the next. They take several years, and it's a very long process. But in that context, I think it'll be extremely important what happens politically in Poland as well. I agree that accessing structural and cohesion funds is a major challenge for infrastructure investment and these type of developments. But politically, what's going to be the choice? Because as Euro area becomes more integrated, more closely related, what are the choices of the emerging European economies there? Will Poland choose one day to move towards joining the euro? Is this the type of decision we need to be thinking about? And I think ultimately it's that second leg of a convergence process how that second leg of the convergence process is chosen, which will become extremely important for the economic development of Poland. And to my mind, it would make sense for the economy to move towards the single currency.
But it seems that for Western Europe, it's quite a risk that European politicians will try to sort of hold or debate until the growth will come. Well, unfortunately, it may not come before they do something. And this sort of, wait and see game that they have, which, by the way, might be good in terms of weakening euro, maybe, against US dollar. But it seems to be a pretty risky strategy, isn't it?
So supposedly, the easy solution to the European debt crisis is the ECB monetizes everything. Germany goes on a wild spending spree, and we depreciate the euro like mad, and then nobody has to do structural reform, and everything's fine. But I disagree with that view. I think Europe's problems, a weaker euro, yes, it's helpful. Stronger demand in Germany, it's helpful, but 1% more demand in Germany may give us 0.02% more growth in Spain and Italy and France. So it's not a game changer. To me, what Europe needs to move forward are the structural reforms. We've seen that the growth models in many of the European countries are simply broken, and to move forward, things need to change. But where I think it's being underestimated at the moment is just how much change has happened at the European level. Just think about the European semester. The first time it happened was in 2011. What has happened is that national governments in the euro area have presented to the Commission their national stability, their national reform programs, before they have been presented to the national governments. Last week, the Commission gave its recommendations of what countries should do, and they will now be adopted at the June summit, and then the parliaments can vote on it. This is a revolution in the way that fiscal and reform policies are set in Europe. So I think the institutional change is happening. You're right, it should happen even quicker. It won't, but it'll take time. But I think if you look at what's been happening in Europe since the crisis, this has been one of our biggest periods of transformation.
Ibrahim?
Yes, let me just follow up on some of these comments, because I share the view that there's really a lot happening in Europe. I don't quite take the same conclusion from it, particularly when it comes to the issues of fiscal and political integration. I think they are useful and valuable complements to an economic integration process that is ultimately, I think, the only one that is politically sustainable and probably the only one that can drive prosperity for Europe. So I don't see integration at the political level proceed quite as much as maybe some people advocate, those that see fiscal union as a prerequisite for currency union to work. But what is maybe more significant is that there are reform processes happening institutionally, but very, very importantly at the structural level in these economies. So what I really wanted to get to, and I touched upon that in my opening remarks, is there are these countries in Southern Europe which for decades didn't reform. But they are moving towards a situation where they are more forceful competitors again. And they probably will be there in a few years' time. And if you look at Poland and some of the other countries in this region, Poland stands out in terms of its performance over the last few years because it did a few things right, but it really avoided doing a number of things wrong. And in particular, it avoided growing on the back of massive debt expansion. When you look ahead at the next few years, and maybe a more challenging external environment, with more competitors, including in Western Europe, I think it will be up to Poland to actually go back on this reform track as well, address some of the structural issues that are still present in Poland, and then join the integration process that is going to be, and I repeat myself, more important at the economic level. Completing the single market in the EU, banking union will be very significant. But I think it's probably fair to say that there's very little appetite in Poland, just as much as in Germany and in a number of other countries, to have really only a limited amount of political and fiscal integration. Because I just don't think we've reached a level of agreement, a level of shared identity that I think is necessary to take that step.
Let me just pick up on a couple of things. I always find it fascinating how all of this discussion about more European integration totally ignores the fact that further European integration tends to be unbelievably unpopular. And so Europe can either continue as a democracy or push integration further, but at this stage in different European polities, it quite simply can't do both. And I think ultimately we'll see democracy win over integration. So hopes that integration solves every problem, to me, seem a little far-fetched. The other thing that I would say is, while we're all recognizing that Southern Europe especially has made huge and significant advances in terms of competitiveness and in terms of reform, and they probably need to do more, and they certainly need to continue with what they're doing, it's, the euro area is still relatively a closed economy. And what we've seen is massive demand destruction in the periphery without any compensating demand expansion in the core. And Europe's problems would be a lot better if core Europe grew faster. And that is a hugely obvious solution that very few people want to talk about, in part because it's politically unpopular, certainly in Germany. But I think that's a big solution to a lot of problems. The real challenge, I think, for Eastern Europe especially, is to figure out what their growth models are going to be. Equity investors will reward growth because it is so scarce in the rest of the world. The next emerging Europe economy that can post 3 4s in a row is going to see a stock market that more than doubles.
All right. Michaela wanted to answer that.
I wanted to respond to that because, of course, it's nice if core Europe can grow faster, especially if France could go faster. But I think if we look at the European economies today, the danger in having the solution to say that the solution to the crisis is only to have core Europe grow faster is, what about the rigid labor markets? What about the lack of education that's taking place in peripheral Europe? What about the rigid product and service markets? What about pension systems? And I think it's extremely dangerous if we don't use this opportunity to move ahead on the reforms, because if you gloss over the current situation just by having a growth plan, and of course you have to decide where growth can come from, but imagine you were able to find a source of stimulus for the economy. Well, it can certainly be helpful in managing an adjustment, but I think it would be dangerous to overlook the structural reforms. So I think when you look towards Europe and you're thinking about solutions, you do have to include the reform. I also wanted to pick up on the idea that European integration is very unpopular. I'm not sure that's true. I was actually amazed by the fact that in Greece, where you saw the very, very painful austerity and reforms being imposed upon the population, that at the end of the day, the population still very much chose the euro area. I'm not sure that the euro per se is quite so unpopular, but it's clear that it's a dangerous game by politicians if you're placing the responsibility for what are structural reforms that would be needed whether you're in or out of the euro. If you're placing the blame of those structural reforms on the euro, it becomes a dangerous game, and that's hopefully one that the politicians will move away from over time, and one that I think some politicians are playing a little bit too close to the line.
All right, we've touched Poland and we've touched Europe quite a bit. It's a very broad subject, global, new divisions of global economies. So let's look at the rest of the world, if we may, for a while. Prior to our meeting, Piotr Kwieciak has corrected me that asking about BRICS is old-fashioned. Am I right? It was you, and you said that there are many risks already now, but there are other places which will be growing very fast,
Yes,
becoming, I understand, a very competitive investment destinations as compared both to old Europe, the new Europe, Central and Eastern emerging, and if I may ask you to develop on this.
I think that the major question is whether we'll progress with this whole moving from the developed markets to emerging markets. And the next step, the next natural step, is to think, okay, those economies has grown so much that they are not any longer small part of the world, but they are a big part of the world. And then when we think about BRICS, they grow significantly over the last couple of years. So the next step in this process is internationalization of the local currencies. Basically, yuan to become a reserve currency of the world. But this to happen, we have to have a situation where the growth model will be completely changed, because that implies that instead of having current account surplus, you will have to have current account deficit, because others will buy your assets in exchange for capital flows. And the question is whether those countries are really ready to switch into domestic demand. Are they so big? Are they so structurally firm? And honestly, I don't think that this is they are ready. We are progressing towards this situation, but it's not yet there. The institutional weakness of all emerging markets, it's quite strong. What is different, and I think that this is the first time ever we are seeing that overall G20 debt, developed markets is around 120%, whereas the emerging markets G20 debt is around 35%. So that gives tremendous advantage, especially in low yields environment, for emerging markets to outgrow the developed world. The question is, if that's true, while the equity in developed markets are outperforming the emerging markets.
Okay, I guess from John Paul there will be answer to that, right?
Yeah, hopefully yes. I mean, the equity in the developed markets, particularly the US, is outperforming emerging markets simply because what the financial crisis perversely showed was actually the resilience of the US economic and corporate financing model. Now, we can argue about what happened with the nationalization of parts of the financial sector and indeed the housing market for that matter, but it's been absolutely striking how quickly the US has come back. By contrast, since 2007, 2008, specifically in the BRICS, there's been a massive reversion towards state-directed policies which have been absolutely aimed at holders of equity in those markets. So as Mark said, if you go through the Brazilian market, for example, you can pick it off sector by sector by sector as the government has hit profits and hit shareholders in order to facilitate the needs of the broader economy. Now, in societal terms, that may be a good thing, but from the perspective of minority investors in equities, it's obviously a very bad thing indeed. And the problem is, of course, that most of the rhetoric out there is still very much aimed at promoting investment in emerging markets as opposed to developed markets. So if I had to guess, I would say that we're approximately halfway through the secular multi-year underperformance of emerging markets against developed markets. And unfortunately, for a market like Poland, that has quite profound implications because it means there's going to be a scarcity of available capital. The other consequence, of course, has been that the estimates from consensus economists, if you like, of medium-term sustainable GDP growth rates in the main emerging markets has come down by anything between 200 or 300 basis points to, in the case of India, arguably up to 400 basis points. The other thing, which we probably isn't the time or place to discuss it, but I'll mention it anyway as a balancing item, if your forecast of growth in China is right, and I suspect it is over the medium term, that also has profound implications for commodity prices. Commodity prices, particularly oil, but also industrial metals, have been key drivers of investment in emerging markets. And clearly that's going to be to benefit the developed world in general and help rebalancing towards the US and towards Europe. And it's going to take money away from the oil and metals producers. And then China is in a league of its own, because China, the corporate sector, is very pro-cyclical in terms of its commodity involvement. But of course the economy, the terms of trade will benefit. By the way, I happen to think that the renminbi is about 30% approximately overvalued at the current level. And you can see that in the damage that's actually happening to the corporate sector there at the moment.
Thank you, Piotr. I promised the voice to Piotr Bielski, who's been silent for quite a while.
Thank you.
Sorry, David.
Yeah, you mentioned that the BRIC term is a bit old-fashioned. That's the fact, because Jim O'Neill, who coined the term BRIC already in 2005, coined the new term, Next 11, which was the group of 11 countries, which were the new, most promising group. And also other economists follow. For example, in 2011, probably, Willem Bitter of Citibank coined the 3G group, so probably Mr. Rabhani can tell you a bit more about this. But it's more or less similar group of countries which are most promising destinations for investments and most promising areas for growth in the long run. But what is important to recognize that is characteristic of almost all of those countries is very good demographic prospects, good demographic. And that's what I think in the long run, if we look at long run investment, is one of the most significant issues right now, is demographic outlook. In Poland, for example, it's a very important issue right now because currently, we are one of the youngest populations in Europe. But in, I don't know, 30 or 40 years' time, we become one of the oldest populations in Europe. And for Poland, which growth model was based on producing goods cheaply. So our growth model was a cheap producer of components for the rest of the world. And it's still one of the main drivers of our growth. That is the biggest challenge in the long run, because with so bad demographic outlook, we would lose our competitive advantage, and we need another one. And the bad thing, the worrying thing is that it's hard to find, at least for now, the alternative. Because if we look, for example, at charts or comparisons of innovation, Poland is at the top. It's definitely not among the leading economies.
I'm afraid it relates very much to the question of IPOs and having something to invest, because being cheap producer of components is mostly FDA-driven thing. We would need innovation and local business activity to have final products that would sort of live off full value chains, consolidating the financials from those value chains here in Poland, and that would be good IPOs for equities, right, David?
Well, I think what's striking about IPOs in most countries, and especially from small and mid-sized companies, is the IPOs are purely aimed at the domestic investor base. So as we see the consolidation of the buy side, the size of an IPO that will interest the global investor community continues to increase. What Poland needs to do, if they want the IPOs of the small and mid-sized companies, is to maintain the strength and the diversity of the local investor base, led by the pension funds. And so if we want Warsaw to be an IPO hub, and we do, what we need to make sure is that we maintain the domestic investor base domestically. There won't be that many multi-billion-dollar IPOs coming out of Poland, or pretty much any other medium-sized country in the world. Maybe one, maybe two every year globally. What Poland needs to do to drive investment is to make sure that the 100 million zloty IPOs can get done, and those will be domestic affairs. And those need to be done in a well-regulated way, in a well-managed way, in a way that guarantees liquidity and access for a broad domestic investor base. And you know, I hope that's one of the things that comes out of this IPO summit.
Thank you so much. We have a little over 10 minutes left. If any of you in the audience would like to ask a question or simply have another comment to what we're saying here, you're mostly welcomed. Microphones are around at the hands of organizers. So, anybody? Questions, comments, anything to add? Well, it seems like we've kept our discussion in a way that would fulfill all the interest about Poland, Europe, and new divisions of global economies. Well, if anybody would decide to have a question, just raise your hand. I'll be trying to look at the audience while we'll keep talking for a little while longer, because I know it's very hard to talk about the future, but you know, living here in Poland back in the 90s and maybe even in early 2000s, we were all living here with the hope that one day we'll reach the level of consumption and personal incomes that would be matching the Western European standards.
Can we travel back in time a little bit?
Sorry?
Can we travel back in time a little bit, like
Sure.
80s?
Well, in the 80s we were far away from that.
Yeah.
But you know, back in the 90s we were saying that it will happen in 20, maybe 30 years, depending on, you know, what's a little bit disappointing for people when I talk to them now is that with all those economic shifts and crisis and the change that is coming, it may be that it's not us going to catch up with the West, it's West going to maybe negatively catch up with us.
I would like to make this parallel to 80s,
right.
Because you know, in 81, Poland partially defaulted and against foreign debtors, and that was the reason of the whole boom which we have in 70s. In 70s, London banks were using petrodollars and basically was lending. It was sort of international debt problem, very similar to what we have seen afterwards. Different instruments were involved in between 2000 and 2007, but outcome was pretty much similar. Unsustainable debt levels, bad investment. Poland defaulted, Falklands, then Mexico, and everything. We ended up with the lost decade. Situation now is very, very similar. Basically, Europe is facing the lost decade. And that's why I think that this year will be very critical, because this year the decision has to be taken and how to share the burden of the outstanding debt. Why I'm thinking about 80s, because basically, you know, in 80s, Poland did what it did. Marshall was introduced and Poland lost the decade. But afterwards, all the structural reform which has happened actually are profiting now. And Poland at the very moment, you can quote me, does not need really deep structural reforms. What Poland needs demand, a creation of demand. And at the very moment, we have a first-time situation in 20 years when there is a recession of domestic demand, and all tools are available, but not used. So I think it's sort of a very weird time, which I haven't seen for many years, and I think that this is something which has to be considered.
Ibrahim?
Yes, I just wanted to follow up on this very good point that I think sometimes in these times of change and difficult times to some extent, for EMs, there is a temptation to look at the Western world, at the industrial countries, and maybe think that they have no more lessons to teach, no more examples to provide. And I think that would be very mistaken. I mean, there are two big mistakes that were made in most industrial countries. In fact, one is to rely on debt to drive growth, and the other is maybe to neglect financial regulation. But the basic growth model for the industrial countries, the one that was driving it fundamentally, is still very much intact, and that is being reliant on private sector-driven activity to be at some point of prosperity and innovation-driven economy. And I think it would be wise by policymakers and by investors in the EM world to heed these lessons, to not look to China as an example of how to grow faster and to grow richer, but to take the good parts of the Western model and to maybe reduce gradually the part that the state plays in the economy, to maybe increase selectively the flexibility of the economy. And then I think that the goal of converging with the West is still it's a good one, it's a plausible one. And it will probably happen at a time when the West has repaired and will not have submerged back to the level of where EMs are today.
I guess what I would say about the growth model is that I live in London and I think about this every day I take the tube this year. This is the 150th anniversary of the London Tube. And the one thing that I take away from it is good public infrastructure lasts an awfully long time and is a fabulous investment. And when I see Polish 10-year yields, well, they're up a little bit, but still below 4%, and I look around Warsaw and I see there are only two tube lines, and I look at the highways, and I look at the
there's
infrastructure.
still only one. The other one is under
Right,
construction.
it's under construction, yes, I know. But there's a lot more to do. There's a lot more to build. And that infrastructure investment, if it's done well, will yield returns for literally centuries.
Well, you're touching very touchy note here because we had a sort of a construction boom in 2011 and 2012, which led to destruction of Polish construction sector.
Well,
So,
construction companies are
you know-
always fabulous because the low bidder always wins, and they go bust all the time. And it's not just in Poland. They do this in just about every single country. Fabulous to watch, terrible to invest in.
All right. Any other comments?
Yeah, also referring to this growth model and what you said recently. Well, of course, the infrastructure investments are important, especially in a country like Poland, which is relatively large and started really from scratch and had infrastructure in complete disaster at the beginning of the 90s. But I think that the critical point have already been passed in terms of infrastructure investment, and the next marginal gains would not be that significant. What is more worrying for me is that we have to, I would argue that we need more active industrial policy in Poland that would focus more on exports, because we did manage to attract large foreign investments, and Prime Minister was pointing today that we attracted quite a large, significant amount of foreign investments. We did, but the problem is that the structure of this foreign investment was not most beneficial for Poland. What could be done more positively if we could channel those foreign investments to more export-oriented branches. Because, for example, if you look at the structure of those foreign investments in Poland, we started from around 60% directed to tradable sectors, and now in recent years there's only about 30% of foreign direct investment channels to tradable sectors. We import more and more foreign capital, which means that we are more and more indebted to the world, but it's less and less export productive. So that, I think, I would argue that Poland needs a change in industrial or more active industrial policy that would channel those foreign funds to tradable sector and to more productive sectors.
All right. Still, there's a question or comment, please. Middle row, please. We don't have much time left.
Hi, my name is Jacob Grosser. I work for economies Brussels, and we're currently working for the European Commission on a project to try to kickstart equity markets and try to kickstart them in a market-based solutions. Now, one thing that we're really focusing on is SMEs. Could you perhaps expand on the nature of the SMEs, on the smaller caps and mid-caps, on the market here in Poland? Now, why is it successful, and how do you see that going forwards? How do you see the effect of this pension reform, of the pension funds, and do you see in the future climate, do you see the mid-caps kind of having a bigger role on the equity on the stock exchange? Thank you.
Well, I think David and Jean-Paul are most well positioned to tackle that question.
What's fascinating, I think, about small cap markets everywhere around the world is they are almost always driven by domestic investors. They're small companies invested in by domestic investors. And so whatever you do to increase the supply, you also have to increase the demand. And so when we look, at least when I look at the difference between the Polish stock market and the Czech and the Hungarian and the Russian stock market, the biggest difference is the pension fund community in Poland has created a sustainable investor base for the small and mid-cap companies. Now, I think it's a very difficult call to make on whether or not this has actually led to an increase in the growth rate or an increase in prosperity, or whether this is actually a viable public policy goal. But you need an investor base, and that's the most important thing. If you've got cash floating around, companies will come and they'll figure out ways to tap it, whether it's equities, whether it's corporate bonds, whatever. Get a pile of money, people will find a way to use it.
Yeah, no, I agree totally with David. I mean, it's difficult when you look at all the emerging markets, really, to think of that many that have thriving SME listed
Excuse me,
sectors.
John,
sorry.
if you could keep closer to the mic.
I'm sorry. And there are all sorts of reasons for that. Clearly, some of them are tax related. I mean, Mark touched on, specific difficulties. I think if you were to pool some of these companies and create viable vehicles, then people would invest in them. I mean, I ran a big emerging market buy-side business for several years, and we really saw very little proposals like that from any of these markets. So, and I agree, I think Poland is different, but there have been features peculiar to Poland, such as the role of management in companies, even before the old system was dissolved in sort of 89 to 91, which have made it different. But as somebody who's followed the Polish market for 20 years, it's been disappointing how little of this has come through. For example, the mass privatization scheme, which could have been instrumental in helping that, was a little bit of a damp squib as far as foreign investors are concerned. So it's difficult, and I can't think of an emerging market that's really solved that issue yet.
Thank you very much. Time is basically up, but let me round it up with one very personal question, which will simplify economic discussion, but on the other hand will put it to emotional test, and we journalists like those kinds of things very much. Imagine you can take not just the capital and invest it anywhere you want in the world, but also with this capital invest your own life in certain part of the world. And starting with Piotr on the other side of the stage, I would like to ask all of you very briefly, where would you choose to live and invest? And I say live and invest because, if you just invest, you stay somewhere else, it's quite indifferent, but I mean...
It's very simple, Italy.
Oh, why there? Because it's a nice climate?
Yes, nice climate, but investment, I don't know, but it's definitely a nice place to live. Honestly...
well, that's how my question was killed.
Yes. I think that, it's very difficult to answer this question, but I tell you one thing. I met my mentor after 10 years not seeing him, and he's 50. No, he's 55. And he said, you know what? My life after the 45 was sort of green. But when you work hard and when you really do all this stuff right, at some stage you will recognize this opportunity of your life, and you will use it. In his case, it came at 48. So now I think it's a very unique moment, because it's about ideas, always it's about ideas, but the time is very unique because I believe in capitalism. Always to build an idea you need capital, and capital is so cheap that when you are ready, it doesn't matter where you will live, but you will make it. Still, I like Italy.
All right, Piotr Bielski.
Yeah, that's a very difficult question. I always had desire to to spend more of my time with a place of better climate. So definitely Italy is a place to go for this reason. But I think, well, I would have big problems to move from Warsaw, as is confirmed by the fact that I still live in Warsaw, unlike many of my friends. So I think I would decide to stay because Poland is still the place of big opportunities. But of course, the dream and the place to invest, as we said. But of course, it would be good if it had also a little bit better climate. But that can these times it can be settled otherwise.
All right, thank you, David.
Well, I voted with my feet and just bought a big old house in London. I still think there's huge opportunities in the big cosmopolitan centers, and if I chose anywhere else, my wife and kids would be awfully annoyed.
All right. John Paul?
To invest, the US and just sort of park the money in S&P index funds, which I've done for the last 4 years, and then when emerging markets have a real bust, then put the money in emerging markets because it's a cyclical asset class, and on the upside you can make a lot of money. As far as somewhere to live, it's interesting actually because our best Polish friends in London, we live in West London, and we have many Polish friends and neighbours, and two of our closest have actually just come back here, so hopefully that's an encouraging sign.
All right, thank you.
Well, I share the enthusiasm for the US and for the UK. I do believe in Europe, but I think one very interesting country and a hopeful case is Turkey. And I say that with a certain degree of optimism, an optimism that Europe will work, and an optimism that maybe Turkey will, at the end of the day, be able to show the rest of the Middle East the right way.
Michaela.
Well, I'm choosing Paris. No surprise there. Great place to shop, great place to live. And also, I think in the future, we will see structural reform in France. It's going to be a bit messy, but we'll get there in the end. So I think it'll be a very good place to invest as well.
All right, thank you very much. So as you see, not everybody is putting the developed West away. There are still believers. There are still believers in developing countries and in Poland. And I'm very, as Paul, a person from, well, maybe not, we're past emerging economy status, but we're still emerging, I have this feeling. It makes me feel very happy. So thank you very much for your remarks. Please, the applause for insights we've heard. And in a moment, next discussion panel. Thank you.
Thank you. Thank you. Roman